What is an option? Options are financial instruments derived from the value of the underlying securities such as stocks. And an option is a derivative because its price is intrinsically linked to the price of something else, such as stocks, commodities, real estate, bonds, currency, and so on. And there are two types of options: call options and put options. And both call options and put options can be bought and sold. And an option contract offers the buyers, or in other words, the option holders, the opportunity to buy or sell depending on the type of contracts they hold the underlying asset. If you buy an option contract, either call or put, it grants you the right, remember, but not the obligation to buy or sell an underlying asset at a set price on or before a certain date. And the key word in this slide that I want you guys to memorize, it is the word rights. Option buyers has always the right, but not the obligation. On the other hand, if you sell an option contract, either call or put, you are obligated to buy or sell an underlying asset at a set price on or before a certain date. And the key word in this slide as well is the word obligation. Option sellers, call options, and put options has the obligation to buy or sell the asset at a certain price at a certain date. The reason why I am emphasizing the words rights and obligation is because in the next slides we will go through some examples where you see these two words comes to play. But for now, just remember that there are two types of options and a quite few style of options that can be traded. Although it's a very simple concept to grasp, I think before we start to see some examples of option contracts, we need to learn and take something out of the way, which it is the concept of option style. These are a few types of option styles, such as American options, European options, exotic options, binary options, Asian options, and Bermuda options. But the two main types of options trading are American options and European options. And the main difference between American style options and European style options is the exercise approach. Exercise an option means we can use the rights to buy or sell an option contract. American style options contracts can be exercised any day on or before the expiration date. European style option contracts can only be exercised on the expiration date and cannot be assigned early to the option seller. For example, an investor who purchased an American call option in January knows that this option will expire in April. The exact date of the expiration is known and listed in the option contract. His option specifies that he can purchase stocks in the company XYZ for $50 per share. $50 is the option strike price, the price at which the option can be exercised. More on strike price later on during the course. In this example, an investor buys a European call option to buy 100 shares of company XYZ in January with a strike price of $50 and expiration date in April. He sees the shares climb to 75 by mid of February. However, unlike the holder of an American style option, he does not have the freedom to exercise his option at that time. He can only exercise it upon expiration date. And again, in a nutshell, these are the two differences between American and European style options. Like I said before, the concept of option style, it's very simple. And throughout this option trading course, we are going to use the American style option. And just to remember, American style option can be exercised anytime before the expiration date when the option holders desire to. And with option style concept out of the way, let's dig into the concept of option types. And the types of options that we have are call options and put options. The buyer of the call option has the right but not the obligation to buy an underlying security at a set price at a certain date, called the strike price, on or before expiration date. The more the option value increases, the more profit you can make. And we buy a call option if we think the stock market will rise. We can also sell a call option. The sale of the call option will initially get paid a premium for selling the call option. More about premium in the next slides. But also has the obligation to sell the stock at agreed strike price if the option exercised by the option buyer on or before the expiration date. More on expiration date later on during the course. We sell a call option if we think the stock price will drop. In this case, if the stock price rise to past the point of the strike price sold, the option seller would have the obligation to sell the stock at the strike price sold. The buyer of the put option has the right but not the obligation to sell the underlying security at a set price on or before the expiration date. The more the stock price drops, the more you can make as a put option buyer. We buy a put option, as I said, if we think the stock will drop. In this case, if the stock drop past the point of the strike price sold, we can profit the difference between the strike price minus the current stock price. We can also sell a put option. The seller of the put option will initially get paid a premium for selling the put option, but also has the obligation to buy the stock at an agreed price if the option is exercised by the option buyer on or before the expiration date.